Hey, Mark, how you doing, man?
Doing good, John. How about you?
I am dandy.
We're going to talk today a little bit about ARM loans.
Arm.
ARM, that ARM. For viewers who are watching, ARM means adjustable rate mortgage, right?
Yep.
So you have your 30-year your traditional 30-year fixed. There are 40-year term mortgages, 40-year interest only for the first 10 years. There are 20-year fixed, 15-year fixed, 10-year fixed, and there are also ARM loans, the adjustable rate mortgages. And you and I had talked about let's share this with our audience to share the benefits, right, of what that type of mortgage can bring. I think the first one that comes to mind that always people always think of is, oh, ARM loans are cheaper. The interest rate is cheaper, and that is true. ARM loans are attractive because they're still 30 years, a 30-year term, but the initial term, so like a 5/1 ARM, and we're going to talk about what the one, you see the 5/1. We're going to talk about what that means as well. But so it's a 30-year mortgage. The amortization goes over 30 years, but the first 5 years is adjustable. So
What does that mean when you 5 year? Oh my goodness, is it 5 years with one rate, or is it calculated differently?
right, that's a great question. So the loan is adjustable for the first 5 years, but the one that you see like a 5/1 or a 7/1 ARM, it's adjustable every 12 months or every 1 year.
Interesting.
Okay, and that adjustment is based upon whatever index that the lender chose, and many of them are the same, but it's the base rate, and if it changes over that 12-month period, they can adjust it. It can. I've had them myself. They can go lower or they can go higher. They don't always go higher. If you're in a favorable rate environment, they can actually adjust downward.
Interesting.
So, yeah. So I think that's a misconception. A lot of people think, oh, if I get an adjustable rate mortgage, my rate's always going to go up. It doesn't work that way.
So if let's do a hypothetical situation. Rates are going up now, but let's say all of a sudden crazy boomerang happens and the rates come crashing down, and I signed up for a 5/1 ARM, and next year, lo and behold, the rate came down lower than my first year rate. You're saying that potentially based on the index, it could actually decrease versus increase.
Right.
Wow.
Right. That's absolutely true. And another misnomer that folks have about, or they have a fear about ARM loans, and it's a misfounded fear, is that, oh, if I get an ARM loan, my rate's going to blow up from, I don't know, let's pick a hypothetical number, say from 4%, and then in 12 months it could go to 7%. Oh my God, I'd never want that to happen.
Yeah.
Well, in the contract, when you get your mortgage, that rate starts at, let's say, that agreed upon amount, and in today's environment, let's just say, again, hypothetically, that's 7%. So going forward, your rate can never adjust according to the contract. This is hypothetical, but it could never adjust more than, say, 125 basis points or 250 basis points, which is 1/8% or 1/4%.
Interesting.
So that's the most it can adjust every 12 months, but it is adjustable.
Okay.
So a person might say, what kind of impact does that have on my payment? Well, 1/8% or a quarter is not going to have a big impact, but you got the benefit of getting that 30-year term with a lower rate with the possibility that it can adjust. So, and there are all types of ARM loans. There are 3-year ARMs, 2-year ARM. There's a 1-year ARM, a 5, 7, 10. You generally max out at 10.
Yeah.
But yeah, they'll just adjust every 12 months, and that adjustment has a cap, so it can't go crazy on you.
Yeah. and I think it's important. It's very timely that we're talking about ARM loans right now because of the rates being where they at. So a lot of people are sitting on the sidelines going, "Oh, rates are too high, too crazy. I can't afford that." Well, an ARM loan is a great way to get into the market, and a lot of people used to use them. As you look 10 years before, back before the last mortgage crisis, uh,
Right.
a lot of people were using arms to get into a home. And that got them in a couple percentage points lower than the fixed rate, and gave them a chance to really step in, step into the mortgage environment, so to speak. So
Right. Right.
that's why it's important that people kind of take a look at, dust it off a little bit, and use it as a tool. It's really a tool for folks to get back into home ownership versus sitting there renting, and throwing money away.
Right. Right. So, a noteworthy point as well is some people have asked what happens after the 5-year term or the 7-year term. The only thing that happens is it just turns into a 30-year fixed mortgage at whatever rate you end up with at the end of that introductory period. So if it's a 5-year ARM and that 5 years goes by and it's had 5 years of adjustments, by the time you get to the beginning of the sixth year, then whatever that rate is, it's just that rate for the remaining 25 years.
Yeah. Now, what's cool? So everybody, if you're kind of your wheels are spinning, you're going, okay, all right, John, that's great. I'm just going to wait. I'm going to wait until mortgage rates come back down. Well, you've heard Mark say this, right? We don't have a crystal ball. We don't
I
know.
have one, but it doesn't work.
Yeah. Oh yeah. Forget it. It's out the window. But you could, and so think about this hypothetically. You find a house, or there's housing coming onto the market. There's more sellers coming onto the market now, going, all right, we're tapping out. People are starting to panic. Might as well sell now while it's still high. You're going to get a good deal right now. So,
Right.
but on the flip side is that, oh no, interest rates are at 7 or what have you. Well, use an arm to get in. Maybe you can get in at 5 point something, right? You
Right.
get the lower bit rate, and maybe next year, and we hear this, right? Fannie Mae saying, "Hey, the rates are going to drift back down a little bit, not to the level we saw before, but they're going to drift back down."
Yeah.
So if you're in an arm and you're seeing rates go, and let's say your arm, let's say you get a 5.75. I'm just making up a number,
Sure.
and the rates drip down to 5.25 next year. Well, why not refi? Lock it in instead of staying in the arm. Lock it into that 30-year fixed at 5.25, and that way you don't have to worry about it. But the arm catapults you into the market, gets you away from renting, throwing your money away. All right. It's, when we talk about buying a home, we're talking about, look, investing. You're investing in yourself, your family, and your future by buying a home. Because let's put it this way: people that bought a home, during or coming out of the crisis, right, buying on that dip, like we're kind of going through a little bit dip now. They saw nothing but appreciation, right? Those people
Right.
are just
Right.
sitting on hundreds of thousands of dollars of appreciation, which you can't do, right? Mark, you and I talked about, you can't make $100,000 and $200,000 on any other investment. Your home has been, always will be, the most one of the safest investments that you'll make, and is one that a lot of people cash in on, and
Yeah.
take that money and reinvest it. But you can't do it unless you get into the market. And someday is not a day of the week. When, oh, I'll buy a house someday. Someday is not a day of the week. There's always opportunity. This is one of those times where the market's slowing down. There's a pause, right? And a lot of people are like, oh, I don't know if I'll get in there. But now's the time, right? Because now
Right.
there's not a lot of competition. You don't have
Right.
a lot of, 15 offers on a home. I will
Right.
say this, and we've said this a couple times already. This is not the same market as 2008. There's not enough inventory. So consider this a blessing that the buyers are pulling back. Don't be one of those people that are sitting on the sidelines. Jump in, use an arm to get in if you're worried about interest rates. and get that house, because when interest rates drift back down, we're going to have all the seller or the buyers back in the market. It's going to be a frenzy again, because
Right.
the builders
Right.
aren't building. There's not, homes. There's not enough homes on the market, right? Average is what, 3 month
Yeah.
inventory, which is
Right.
half of what it should be, and it's not going to improve anytime soon. So
Yeah. Another way to look at it, if you're a viewer watching this, is to think about it as a 1-2 step, right? Think of it in terms of you secured this piece of real estate that over time has always appreciated in value. So that's step number one, secure the property. Step number two is, even if rates are higher right now, refinance when rates come lower. Now, again, we don't have a crystal ball. We don't know if that's going to happen, but it fluctuates. There's a fluctuation in the marketplace for interest rates. So step number two is refinance when that opportunity presents itself. You're not going to get the 2-for-1 all in one shot. You got to make the purchase and then wait for rates to come back down and do the refi if that's what you want to do, to a 30-year fixed. But this arm loan is a way to pry bar your way into that process so that you're in that position when rates do start to come back down, or if they do.
yeah, I agree.
Yeah. So uh I think it's just taking advantage of two processes. It's price softening in the market as interest rates go up, but prices will refirm when interest rates come back down. You don't want to be a buyer when interest rates drop.
No.
You want to be the buyer now when you get the deal, and then refinance after you're in the driver's seat as the homeowner.
We should probably do a whole show on that, because
Yeah.
honestly, you just hit something that a lot of people don't get, and that is, a lot of folks say it's time to get out. Right, the rates are up, time to get out, time to book. Let's sit on the sidelines. And you just highlighted, now's the time. Don't you, the interest rates and mortgages is kind of like the fog, right?
Right.
It distorts people's vision about the real objective here. The objective is the price of the home and the market and getting what you want.
Right.
And that is the number one, right? So there's tools out there like arm loans and other loans to get you in, but don't get caught up in the frenzy of the mortgage and interest rates to miss the objective, which is to get the home at a decent rate. Remember, and I think you said this a couple of videos back. The there is savings now, because people forget that there was escalations on the home. I mean, you may have made an offer at, let's say, 325,000, but you had an escalator all the way up to 360. So
Right.
you ended up paying 40,000 more than what you originally wanted to offer. Guess what? When you go in now, there might be some haggle room depending on
That's
how
right.
long the property's been. So you might actually go lower than the listing price.
Right.
But hey, that interest rate, you know, that makes me pay an extra $50 a month. That's going to keep me on the sidelines. You gotta think about that, and
Right.
think about what your objective is. If it's about getting the lowest payment, well, there's tools out there.
Right.
If it's about getting a home now, about getting the best deal, it couldn't be a better time, to be
Right.
honest.
You've as a buyer, we have to think opposite the market, right? And it's hard to do. It's really hard to wrap your mind around. Buy it when prices are dropping. Don't buy when prices are escalating, because uh, that's when you get not the best deal. You get the best deal when you feel the most insecure, right? Prices are dropping, interest rates are going up. That's exactly the time you should be buying,
Yeah.
because now you're getting the value on the property. Interest rates at some point, I don't know. Again, I don't have a crystal ball. I can't forecast, but if rates come down, then you're in this great position, because not only did you get a good deal, now you're going to get a great interest rate to go with that deal. You just can't get them both at the same time.
Yeah.
Just like when interest rates were at 3%, right? Or 2.5%. You could get the great rate, but you couldn't get the great price on the house. So it's a 1-2 step. And if you get those timings right, you're golden.
Right. And this put the ball back in your court. The arm loan, and I'm just coming back to our topic, the arm loan gets you that control. It gets you
That's right.
the lower payment per month, and then then you can control when you really want to shift and move to a
Right.
flat rate for the rest of the term of the mortgage. But those ARM loans, depending, like you said, it could be a 5 year. At 5 years, there's a lot that can happen in 5 years on interest rates.
Yeah.
Uh,
Yeah.
they could, and a good savvy homeowner is going to be paying attention to those interest rates. And a lot of people do. They, as soon as they see those rates start dropping, they're refining. Right? Ask Mark. I'll do it during the boom of low interest rates. Refis were just flooding in because
Right.
smart homeowners were, all right, I'm taking my rate down. I'm going to save some money. So
Right.
there'll always be opportunities to save money, and there'll always be ups and downs on interest rates. But I think the point we're making to you is that inventory is not going to go up magically.
Right.
It's going to stay around this level. And because of that, what will ebb and flow is the amount of buyers on the market. Right now, buyers are freaked out. So they're backing off, which is good. That means you, as a person
Yeah.
that's watching this video, can
Right.
go, boom, okay, I'm in the driver's seat. I got some tools. Let me go out and start looking at the homes that I want because I can negotiate. And look, you can see when you look in Zillow, you look at my website, you look at everything, homes are staying on the market longer now. So
Right.
sellers are getting a little itchy. They're dropping prices. I saw one today drop, 20,000 because it's been sitting on the market for a month. So
Yeah, that's huge.
yeah, it is. It's pliability though. So this
Yeah.
is definitely a good time.
Yeah.
Okay, Mark, great interface on the ARM loans, and
Yes.
I really think good discussion about it, as well as it being a good tool. And as always, looking forward to our next topics as we get into next week. And in the meantime, have a great weekend. Okay.
You too. You too, John. Thanks very
All right.
much.
Thanks.
Okay.
Take care. Bye
Okay.
bye.
Bye.